Welcome to the Defenders of Business Value, the podcast that helps business owners unlock the value they've built and exit on their terms. I'm your host, Ed Meisegland, and for the last 30 years, I've been helping business owners prepare, grow, protect, and ultimately sell their businesses. Whether you're a business owner, a buyer, or an advisor guiding others through the process, if you want to make your last deal your best one, you are in the right place. So let's get started. So welcome to another episode of the Defenders of Business Value, and I'm your host, Ed Meisegland. There's these guys that we're going to have on today. They own 15 companies. So Colin King, he's a CPA and CFA, and for those of you that are in that world, he brings significant horsepower. He's an ex-Big Four auditor turned Holdco CFO. And his partner, Joe Van Deman, he's a former Google guy. And here in little old Indiana, they have a company, Holdco, called Circle City Capital Group. And way back when, in 2019, they got their first deal. And since then, they've been going on to build an organization that has 15 companies. They have apparel, Montessori, financial training, just to name a few. And one of the best things that came out of the episode is how they met each other. These guys have just killed it. So today you're going to find how they find these overlooked businesses, how they roll up their sleeve, what was needed. And then for the sell side, how people like these guys, how they look at businesses, not just financially, but emotionally, and how they come alongside these business owners and really how to do a deal that benefits everyone. I hope you enjoy my conversation with Colin King and Joe Van Deman of Capital City Capital Group. Joe and Colin, welcome to the show. Been looking forward to this for quite some time.
Thanks for having us, Ed. We appreciate it.
You guys are sleepers because I don't think anybody knows what kind of horsepower that you guys have. And being a guy in the community, I had no idea that you guys had this kind of operation. And shame on me for not knowing until now. I knew that you had companies. I didn't know you had this many companies. So it's pretty interesting. So you care if we get started?
Yeah, let's dive right in.
First, how did you meet and how did you become partners? And I won't tell anybody, but how have you stayed partners?
This is usually a coin flip on who gets to tell this story. And Joe always loses this coin flip because he tells it so much better than I do.
So Ed, both Colin and I were at a point that we were feeling a transition in our careers, and we were poking around at the idea of starting a business or buying a business. But you'll find that both Colin and I, we don't always go the traditional routes for how we look at things. And my presumption at the time is there's a lot of businesses out there that people don't know about a broker. They don't know how to sell their business, and they're just trying to get out. So I had posted an ad on Craigslist that just said, if you're interested in retiring or you want to sell your business, I'm a local guy and I would like to talk to you and see if it's a good fit for what I'm looking for. So I had done that, off and on for quite some time as I was starting that search of looking for my first business, and talked to a number of really interesting businesses that came through that channel. And one day I got a phone call from Colin, and Colin was on Craigslist looking for a business for sale. So he called me and he said, don't have a business for sale, but I think we should talk because I'm looking for a business too. So we ended up connecting through Craigslist. We had an initial phone conversation that probably lasted 45 minutes and then decided we should get together and have a drink. And we found that we just had really similar interests, really similar vision and values in terms of where we want to go. But at the same time, very diverse experiences and skill sets that were really complementary to one another. From Craigslist, Colin and I ended up becoming friends, and we started looking at a number of deals back and forth and just shared our perspectives on those to one another. We probably looked at, I'd say 12 or 1,500 deals before we really got into our first business together. So that's how we started many, many years ago now. We're still together to this day. And it's somewhat like a marriage, having a partner, as you know.
We did wind up finding a company to buy on Craigslist.
Wait, Colin, you're right. He articulates that really well.
Right.
That was really good. But the thing is, it's not one business. How many businesses are you guys up to now?
So we've acquired probably 14 or 15 at this time. Yeah.
The deal universe, I'm certain rewarded both of you on being good stewards of your personal assets and what you're doing with your life. And you know what? I'll find the best partner for both of you. And here we go. 14, 15 businesses later. Did you know that Colin was a CFA? What was that like? Because I know from where I sit in the businesses we look at, I can only imagine Colin cringing when getting the financial statements.
I think that's really fair, Ed. And, that's one of the things that I think really, really pulled us together in that partnership is, Colin had that really high level of financial training. He's a CPA and a CFA, and he was really, active in the public markets and wanted to start to deploy some of those same ideas into the private markets. My background coming from Google, I was a little bit more entrepreneurial, a little scrappier, and I really get my hands dirty in different operations and things. So I think that's really what's helped our partnership grow and continue to be stable. Colin says, this is where we're at today. This is where we need to be 12 months, 24 months from now, and is able to really provide that great 30,000 foot view. And I'm the guy on the ground saying, wait, where are we going to get the next 4 people to work for us? Where's the next dollar of revenue coming from, and those types of things. So I think, it's developed into a really healthy relationship where we both have a strong respect for the other, and we can sit back and say, if anyone raises their hand and say, well, let's put the brakes on, we're not going to move forward on something, because we know that it doesn't work. If it doesn't work on the operational level on the ground, and we got to pull back. If it doesn't work, in the 30,000 foot view, it's not going to work. So, we look at the things, but provide some very different perspectives and make sure that it's aligned with where we want to go long term.
This has really been our superpower, Ed. Joe and I have totally different worldviews in just the things that we were trained on, in our professional careers before we came together. And so he's got that perfect blend of ops and marketing mind, and then I'm kind of the de facto accounting and finance mind. And so those two worldviews coming together has just been immensely, I can confidently say I wouldn't be where I am without Joe. And I would like to think he would say the same thing about me. So it's really having that perfect complementary skill set that's gotten us to where we're at.
Interesting. And so like any marriage, you have your honeymoon phase, and then you kind of settle into, all right, this is great. This is, my partner for life. So after your first deal in 2018, you paid some tuition, right? So you're out hustling at 2:00 in the morning. Again, back to being, let's just use the marriage analogy. That's a different animal. You're now doing life together. In this case, you're doing deals together. So tell me about that first deal and how it shaped everything else that followed.
I think that situation was really trial by fire, because we looked at it when we got into it and said, oh, well, it's only a commitment of X dollars, right? What else do we have to lose? And come to find out, there's a lot more. There's a lot more that you can lose, like your sleep, your time, your sanity, your relationship with your spouse and stuff. I think we learned a ton. We learned a ton both financially and operationally, right? On the financial side, it was a nice business because we didn't have any working capital. We got paid weekly. All of our expenses went out weekly. And so it was kind of a nice financial model. And then operationally, it was just a flaming pile of garbage. So we jumped into it. I think our first night we showed up and maybe 2 drivers didn't show up for work that night. And it was like, okay, here we go. What are we going to do? And so we really had to divide and conquer the duties and how we were going to fix that thing up and get it into a position where, we weren't the first line of defense in that business. It took a lot of navigating on the fly, and I would handle one subset of tasks and Joe would handle another subset of tasks. And we both just kind of went at it full time.
We see a lot of partnerships, and there may be 50-50, but, somebody's always sitting there thinking that their 50% is bigger, or I do more and things like that. So did you guys bump into that?
I won't speak for Joe, but from my standpoint, we've been working together since 2018 and talking since before then, well before then. And I don't think we've ever had a moment where we've had to go to each other and say, hey, what are you getting done, right? Are you chipping in your 40 hours? I think it's always been, we're driving towards something. We have goals and objectives, and we're both super passionate about it to the point where, even in your free time, that we're both thinking about things. Joe will text me on the weekend, hey, I was thinking about this thing, or I saw this thing, and I'll do the same, It's a blend between what you love doing and what you're working on. We've never had a hard and fast, you're responsible for this stuff and I'm responsible for this stuff. Some things kind of naturally fell that way based on skill set, but I don't know, Joe, what do you think?
Yeah, I think the other thing is just in addition to a deep respect for one another and their skills and what they bring to the table, I think we both have that ability to really pull a rabbit out of the hat at different times. And there are times that I look at it and we're just like, man, what are we going to do this week? How are we going to get through this? And then Colin engineers something that's like, wow, like that makes so much sense, right? And I think I've done the same on many occasions too, that out of nowhere we feel like we've hit a roadblock and it's like, oh, well, this just up-leveled us, or this just completely changed the game. So I think we have that partnership, and part of the reason why it's really valuable to me to have a partner is we have a little bit of that flex time. If you're in it on your own, you're in it 80 hours a week, there is no reprieve from it. But, I talking to Colin, if you look at Colin, he really values like his physical workout, and even times that we're stressed, he's still spending time to do that. I really value, that time with my family, and even times that are tough and we're putting in long hours, I make sure I dedicate that time with my family. And I think those are the things that really allow us to step back and think through some of those things at a larger, higher strategy level and put things in perspective. Because as you suggested, Ed, that first business that we had, an overnight trucking business, man, that's tough, right? We'd have drivers call off and I'm in the truck and I'm driving, 450 miles in the night, in the middle of the night, and I'll get a call from Colin at 6 a.m. and he's like, hey, I got an idea. We should double the size of our business. Let's acquire another one. And I'm like, what are you talking about? I'm on the road still. So I think it was really just that healthy push and pull that we've had, that one of us may be in the hot seat for a time, but the other one is looking out for the longer term view and where do we go next and how do we get out of this situation where we're at.
I know a lot of, especially first time buyers, start talking about partnering up, right? That I want to bring somebody that brings skills that aren't necessarily my own. Is there like leading indicators of, what, this could work? Because you guys are a little bit different, but I think that you both knew yourself well enough to identify what made a partnership work. But I say that because of where you both came from versus somebody that's like, all right, buddy of mine, we want to be partners and we're going to go buy a business. We get that a lot. And so I'm just kind of curious to know what would make you say, yeah, you know what, this is not a good idea.
I think there's a lot of front end work that goes into it. Joe mentioned we tossed around a lot of ideas. We spent a lot of time together before we did our first deal. I don't know that I've ever gone back and looked at how much time we spent together before we did our first deal, but that back and forth, it's work, right? I mean, you're looking at deals and you're analyzing it and you're talking about how you would do something, how you do this, how you do that, where you would take it. All that thought process, really goes into unpacking how a person thinks, right? And what they bring to the table and how they think about things, how they would approach things. And so that front end work, I think, melded the relationship before we got into the first deal together. And, I think there was like an intuitive competency test that each of us had on each other, right? Like Joe is a former Google employee and insanely intelligent, right? And just operationally sound. I mean, the guy, when a truck would break down, he'd go to the freaking junkyard to find some pieces off of a broken truck to fix our own trucks. Like, holy cow. And then on his side, evaluating me, it's like, yeah, there's a certain amount of competency you need to do the CPA, CFA thing. So we both knew we were competent people, and then that front end legwork of looking at deals together for a long time and talking it through, I think formed where we're at. So if someone's looking for a partner, I don't think it's like an overnight thing. I don't think it's like oh, hey, I'm friendly with this person. Yeah, we could do a deal together. Like, I think there's some vetting that goes into that.
Yeah. No, I think you're exactly right. Sorry, Joe, that I think that you need reps at looking at businesses. Your buy box needs to be aligned and your post-acquisition integration needs to be aligned.
The two things that I'll add there that I think really help with alignment as well are, what are your long-term goals? Colin and I have both decided, like, we're in this for fun and we're in this for life. We didn't want to buy a business and turn around and flip it in 3 years to a private equity firm and then go off to the beach somewhere. We enjoy looking at businesses. We enjoy innovating. We enjoy operationalizing. We enjoy those different aspects of building the business. And that's something that we wanted to create a vehicle that really allowed us that flexibility. And as our interest and our time changes, priorities change over time, we just said, we want to do this into our 60s, into our 70s, where we can always look at businesses and say, you know what, that would be pretty neat if we did X, Y, Z. I think we both had that shared mindset, and neither of us is really looking for, let's get a big cash out and walk away, because I think that, hurts a lot of partnerships. The other thing that I'll mention is, I think having a similar tolerance for risk is really important. Colin and I, it's obviously risky in buying a business, getting a loan and going through that process and, just operating a business. It's not for everyone. But Colin and I'd say we have a relatively similar level of risk, but surprisingly, Colin is probably a little more risky than I am. And he's the finance accounting guy that does it all by the book. I think it's a healthy relationship, but I think we're still, decently close on that spectrum. If we were a lot farther apart on that spectrum, I think it'd be really challenging for us to continue growing our businesses together and have a strong partnership in doing so.
Comp expectations probably the last thing, right? I mean, Ed, I don't know how most people will look at comp at a small business, but Joe and I guess philosophically have the same mindset of like, yeah, once your basic needs are met and you're living comfortably, like we would turn around and redeploy anything else back into doing more of this, right? Because we enjoy doing it. And so it's pretty uncommon for someone not to want like just a continual hockey stick of increasing comp expectations. So being aligned on that is probably more challenging than where we lie.
Interesting. Well, you describe yourself, you're not a private equity group, all right? Even though you have 15 businesses, let's talk about your shop versus normal private equity.
So we're not private equity, as you say, Ed. And really, for listeners who aren't real familiar with private equity is a process or that system where there's a large pot of money out there. There's a fund that's backing someone who's buying these types of businesses. And that's either, a fund that was raised from a number of high net worth individuals or an institutional investor of some sort. Colin and I don't have any of that type of backing. So from deal number one, we walked in and it's our personal balance sheet on the line. So similar to a lot of other people that you sell businesses to, Ed, it's very much a personal business decision for us where we're all in. It's something that we can't allow this business to go under. So I think it allows us to operate in a very different way. Private equity generally has a time frame of, call it 5 or 7 years, where they have to grow a business, create a significant amount of value, and then turn around and exit that. We don't see that as always being what's in the best interest of the business. And since a lot of the businesses that we really focus on are businesses that have been around for 20 years or 40 years, we don't think that an intense period of 5 years of growth is necessarily the best move for that business. So when we look at a business and say, what's the value today and what is it tomorrow? What's it look like in the future? We can take that longer view and say, we plan on holding this for maybe 10 years or 20 years or even 50 years, if it continues to be a good business for us. So I think our expectations for growth, for return on capital invested are just very different. And because of that, it allows us to make decisions that are really in the best interest of the business versus decisions that are in the best interest of the investor, as is typically done with private equity. And because of that, I think you'll see that we make different decisions. We have better relationships maybe with some of the sellers of the businesses. We have better relationships with those employees that oftentimes come over with the business because we're just more aligned with growing it as a small family-owned type business versus something that has intense expectations for a return.
Call it foolish or not, I think most people would tell you to buy a company with an exit in mind, like at the outset. And we don't do that. Like, I don't think we've ever bought a company thinking about how we're going to get out of this thing. So I think you'll wind up seeing us just continue accumulating different things in the holdings and just keep snowballing it and bolting on to what we already have. I think we're looking for good companies. We don't have an outside fund or backer or source of capital, and we're willing to hold on to stuff. It doesn't mean we're in the never sell camp. We've sold 2 things along the way. And if the right opportunity presents itself for that, then we'll look at it. But we're buying stuff that we like, we think has a good long-term trajectory to it, and then we'll just sit tight, just keep cobbling together the portfolio. That's really the plan.
To me, this is an asset like any other asset in your portfolio. This just happens to be a privately held business as opposed to a publicly traded equity, right? And so you start looking at your returns, that as long as this asset is producing for the aggregate portfolio, why would I change? Other than risk, you know what I mean?
No doubt.
See, I pay attention. So how do you target these businesses, by the way? I mean, what are you looking for? Because they're across the country. I mean, it's not like they're in our backyards.
We'll eventually get some employees here in Indiana. I think we're still the only two. Yeah. I think it's still just
We
us.
have one other employee in Indiana right now.
Oh, you're right. Oh, man. I feel bad saying that now. That person's going to kill me. You know, I think when we first started out, it was just casting a huge net, turning over a ton of stones, looking everywhere, not one singular source. I mean, we were finding niche brokers. We were doing biz by sell. We were obviously doing the Craigslist thing. And we were just turning over every stone and looking everywhere at everything and really kicking the tires on a lot of stuff. And then once we got into a few industries, I think we found that when you already own something, you wind up, you know, knowing and learning of and talking to the other players in that space. And a lot of our deals recently have been sourced internally from the industries that we're operating in. I mean, really probably like the last, Joe, 3 or 4, and including some deals that are currently in the hopper are all sort of known players in the industries that we operate in. So, and then really the rest of it, I would just say, is kind of like management by walking around or wandering around, right? You're just kind of looking around and you're looking for things and you're talking to people and you don't know where opportunities will come from. So we've been mostly opportunistic, maybe not mostly, maybe entirely opportunistic into where we've gotten today. And I think that's also part of our strategy, or maybe even our lack of strategy, is being opportunistic and not trying to force something. Has been an advantage for us. So
yeah, I think that's right. And Ed, you've seen it. These people that want to buy a business, they come in and say, I just need a business that does this. And they give you a checklist of about 100 things, right? And they say, oh, it needs to have an EBITDA of $500,000 to $2 million. It needs to be trading at a 3x multiple. It needs to have no customer concentration. It needs to have no supplier concentration, you know, all these things that they want. And I think, you know, you've been around small businesses just as more than we have to know that those businesses may not exist out there, right? Every business probably has some warts on it, right? Where you have to say, that's not the best, but we'll deal with it and we'll manage around that. So when we're dealing with businesses that are, you know, under $5 million in earnings, I think we're going to find those things. And I think what Colin and I have decided is that we're okay with some of those things as long as we don't have to check 100 different boxes. We want to check off maybe 60, 65 of the things that are on our list and be comfortable with the other ones that it doesn't check the boxes for. So an example of that, one of the companies that we purchased was a blue jean manufacturer, and we sell these blue jeans, and it's a great little business. The first day that we walked in the door, there was only one supplier for that core denim blue jean product. So we said we quickly need to move out of that and diversify. And today we still operate that business, and we have 3 different suppliers that are making blue jeans for us. So it was something that we were capable of doing. It was something that we could act relatively quickly on. But we recognized that a number of other people were scared away from that scenario because they said, oh, there's too much supplier concentration. So we feel like as long as we pay the right price for the business and we recognize that there are those things that need to be done and we can write a deal that makes sense for everyone to protect our downside, then we'll go ahead and take a chance on some of those, even if we can't check all the boxes.
By virtue of the things that you've seen and the reps that you've undertaken, does risk change for you as you're looking at deals? Like in your case, you're saying, all right, there's a workaround. We got a supplier concentration. This is viable. I can fix it. I can mitigate the risk. You know, so as you're looking at deals, are you looking at the opportunity, or are you looking at it from how do I mitigate all this risk and buy it, recognizing the risk inherent to the company? And yeah,
it's interesting. It's almost like, are you focused more on eliminating the downside, or are you focused on what can you build with it? Right. An upside first focus. And I guess so now that we own a whole bunch of other things, I think my answer would depend on, is it a brand new thing, right? Is it an entirely new platform that I am starting with and I need to build from, or is it adding to something I already own? So we own this decor business, and we bought a company with huge customer concentration, but it fit within the business that we already owned and added a lot to that existing business. So when we looked at that, it was like, okay, the downside's probably worth it here because we're getting these 2 or 3 other resources along with it. But if that's your first deal, then you'd say, okay, well, shoot, I don't know. I'd have to quickly do some other things to mitigate that potential risk. So from a first deal standpoint, maybe it's a little bit different than doing like a tuck-in or an add-on or something. I guess the way that I think about it is it just depends on how surmountable that risk is. Joe's point is if most biz buyers have like a 100-point checklist and they're looking for 90 out of 100 checks on that checklist, then we're probably looking for like 60 and thinking to ourselves, okay, what can we do? Like, what's our value add to make up the gap for the other 20 to 30 that maybe other buyers are looking for on that list. So
I mean, we've got 18,000 buyers on our list, of which I'll say 1% will ever transact for the reasons you're saying, because I think the buyer is looking at, all right, what is this investment and how do I mitigate the risk in order to preserve the earnings, as opposed to how do I maximize the earnings in order to, I don't want to say pocket it, but you know what I'm saying. I think that's the difference. I think you've turned this whole thing on its head a little bit and are looking at risk as opposed to the earnings. Not that earnings aren't important, you know what I mean?
I think that's fair. And then, Ed, the other thing that we look for in these businesses other than just risk is we look for some of those opportunities. Any business that we've purchased, we walk to that table and say, you know what, there's probably 5 or 6 levers that we can pull coming out of this. Could be adding a complementary product line and selling to your existing customers. It could be opening up a new sales channel. It could be it's something as simple as a website redesign and really driving a lot more traffic through SEO or paid ads or something. So we say we buy it for what the business is doing today, knowing that there may be some things that make it not perfect. And then if we can execute on 1, 2, 3, or 4 of these levers, then that's where we find a lot of upside and a lot of value in the business. But we buy it for a fair price today based on what it's earning and how it's operating.
Yeah, no. I didn't imply that you're minimizing the value. But again, as we coach sellers on a regular basis, different buyers will value, there is not one number. And it just depends on who that buyer is and how they see it. And anyway, looking at all of the deals that you do, I can't fathom just some of those value conversations, because I know it's painful on my end. All right, so what does your buy box look like now? Now you've got a portfolio, right? Are you adding to the portfolio?
Yeah, absolutely. I think we're always looking for quality businesses to add to our portfolio. And I think our buy box is different, as Colin suggested, for a business that we already have, where we could say we tuck this in, we use our existing operators, we can leverage some of the scale that we have in place. We would take on a relatively small business or even a product line that may not be a fully fledged business, but says it just makes sense to tuck that in. So that's one thing. And then the other is, what's our buy box look like for a new platform? If we're going to start something from scratch and say it's a new industry for us, we don't have experience here, but it's something that we think we want to hold on to long term. So for us, there's more of a platform business. We're looking something that has probably at least $500,000 in annual earnings. We really want to be able to support someone who is that operator, call it a CEO, a general manager, whatever that is. We want to be able to support building out a team under that person or that team so they can really operate the business. Colin and I, we've sat in that operator seat for a number of our different businesses. We've done it at times of transition. We've done it long-term on some occasions. But we've really identified that's not our skill. We're not the best at that. We're good at finding someone who's really that great day-to-day operator. And we need someone in each of our businesses that wakes up and thinks about driving that next dollar of revenue. Following that, we're a great resource for saying, great, let's sit down, let's talk about your strategy for 90 days from now or 2 years from now, and how do we grow the business for that. We're also great at special projects and going in and saying, how do we handle X, Y, Z? Let's put some additional firepower behind something. So we're really looking at a business that can stand on its own and then really has some potential to grow either organically or through acquisition in years to come. But it's something that we want some level of certainty it's going to be around for another 10 to 20 years.
So who is operating? Is this a matter of the owner is taking some proverbial chips off the table and wants to hang around, or you got a key person?
I think we've historically wound up buying from an aging seller, right? So we'll wind up bringing someone in just about every platform we run today, with the exception of one. We brought someone in to run it, and someone who's like pretty good in that industry that they're in. And then the goal is we add value where we can add value, right? And that's with some ops and marketing guidance and some finance and accounting guidance. And then really our skill set is finding these things and getting deals done and finding good value, right? And be a little more like tangible about it. I think we're looking for companies that have been around for a long time and have had minimal investment in certain areas of their business, something where we can come in and like breathe some new life into the business. And usually there's some kind of a hidden gem in any company we've looked at. I mean, we've looked through a business and said, hey, if we can get rid of A, B, C, D, then we're left with this, and this is amazing, right? And so we've picked the company up and moved it and relocated it and just said, hey, we're gonna shed everything except for this one piece of the business. In full transparency to the seller at the time we were going through that, but I think it's just having a creative eye to what you're getting. But long tenured business, usually an aging seller that's has a good business, built a good business with good customers and products. And then it's just to that point where the next level of enterprise value growth would take a significant amount of dollar investment, work investment, new hires, et cetera. And then we can come in and kind of champion that strong but old brand into the next phase of its life. I think that's really like what gets us most excited.
So the capital that you're using to acquire, are you, especially the bolt-ons or some of those others, I haven't met anyone that has utilized the SBA expansion loan program. Are you guys using it or no? Have you found it?
What's the program? It's just the SBA 7A?
No, it's the expansion loan where if you're buying within the same NAICS code. Yeah.
So we haven't used that program. I think that's still partially dependent on the lender being willing to do that, right?
I don't know. I mean, it's a new thing where, if the combined company, right, the global cash flow can be supported, you don't have to put any equity into it, assuming that you have the balance sheet to support it.
So we have not gone down that path yet. We have done the SBA. There was a brief window where you could do the seller rollover equity in an SBA loan and not have them, PG the loan. And I think that's gone now, but we were able to get one of those done, which was nice, right? And then you've got a motivated owner, and that owner actually is still actively, doing BD, acting in a sales capacity, which has been pretty helpful. So yeah, we've gotten creative in just about everything that we've looked at and getting them done.
Valuation. You and I are BV guys, so out of curiosity, I mean, what's it like building out that forecast for off those QuickBooks financial statements?
I like to say that small business accounting is the Wild West, right? You just never know what you're going to run into. And we've come across companies with great books and come across companies with horrible books and everything in between. In an ideal world, and this isn't always available, but if you can get like a transaction export of all the bank transactions for a business and then just rebuild your own cash flow worksheet, like that is the best starting point. But that's like perfect world scenario. So yeah, I mean, it takes a lot of unpacking, and I think that's why we lean on companies that have been around for a long time, right? Like history begets survivability long term. And like there's some reliance on, okay, they've got a big customer base, right? There's repeat customers, there's a product portfolio that makes sense here. So you kind of like, you're doing some scuttlebutt to rely on other bits and pieces as opposed to, it's not just a pure financial statement exercise, just because these businesses don't have like audited purely GAAP financials. It's like this weird modified cash basis of stuff that you're looking at.
So you got all these, it's kind of like, who's your favorite kid? So out of all these businesses that you own, is there one for each of you? I mean, that you're like, what, I like this. I seem to gravitate to it.
Yeah, I know Joe's, and you probably know mine.
I think, you've seen it more recently too, where it's become popular, this idea of buying boring businesses. And Colin and I said that at the outset several years ago, that we're happy with boring businesses. And somehow we ended up with some businesses that are not boring businesses at all. One of our companies is a manufacturer of apparel, and it's here in the U.S., which is really just nice. The shirt that I'm wearing today, it's one of our shirts made here in the U.S. We sell them in our brick and mortar retail stores. We sell them online. It's the Vermont Flannel Company. It's just a really great brand and growing a lot. So it's been a lot of fun to work on. Associated with that, we also own a teddy bear manufacturer, which is just really hard to wrap your head around. We're probably the largest teddy bear manufacturer in the country. And we own a big building that you go and you make teddy bears there. It's just pretty amazing.
It's like Build-A-Bear on steroids, huh?
It's one of those, it's hard to say those are boring businesses when you're making some really great physical products that your consumers love. Our teddy bear factory, we get more than 30,000 visitors a year that come to tour the factory because they want to see how teddy bears are made. It's just pretty amazing.
And then you get the Slack channels full of, hey, Tom Cruise came in and bought some flannel today. It's like, okay, that's looked up a whole Wednesday afternoon.
Rock on. Good for you. All right. Colin, what's your baby?
We own this financial training and education company, and it's hard for me not to love it just because it's a topic I'm passionate about. And like it also dovetails nicely with helping business owners and potentially business buyers like better understand the numbers they have, which I think is a key ingredient to buying or selling a company and owning a company that actually makes money and can send cash distributions to you. So Profit Mastery is our financial training company, and I think it's pretty cool business.
The manufacturing I can see, right? Those are easy ones. Those are layups to everybody's chasing manufacturing. Profit Masters, right? Is that what Profit Mastery? Sorry, how'd you get there?
We own a company that is an Ohio LLC, and during COVID, Profit Mastery was working with various states to have their course distributed through the state business development centers. And Ohio was one of those states. So it was like, okay, all business owners in the state of Ohio had access to this program during COVID. And we were notified that we had access to this. So Joe sat through the first session and he's like, hey, you got to check this thing out. It's really cool and kind of fits our mold of the things that we're looking for. So we just reached out to the owner of that company. We said, hey, we took the program. We really liked it. And this is who we are and what we're doing. And we'd love to stay in touch. And, it took, 3.5 years of talking to him off and on until we wound up getting to a point that he was ready to pass the baton. And then we bought the company in late 2023. So it was, I kind of like internally sourced, I guess.
So when we look at the composition of the people that listen to the podcast and the newsletter list, it's probably 50-60% business owners. The balance are their advisors. Because you've looked at so many businesses, I'm hoping that you could say, you know what, this makes you really unattractive. This is really not what you want. If you want to put your best foot forward to any buyer, whether it's us or anybody, these are some of the tips that you've got to get your arms around. And I know we probably need to talk about value expectations as well as the condition of your financials. But I think, I'm looking for a little bit deeper that it's like, this is just a put off right out of the gate.
So one thing that I really look for, Ed, is a seller knowing what they want. So there's a lot of people that have been running their business for 20, 30, 40 years, and it's part of their life. And what I really like to hear is that they say, I'm ready to sell my business. Here's my plan going forward. This is what I want to do. And that could be continued involvement in the business. It could be going to sit on a beach somewhere. It could be, following another passion or something like that. But Ed, we've talked to a number of business owners, and I would say one of the top deal breakers is when that seller doesn't know what they want in terms of future involvement, in terms of end date, in terms of those types of things. And we're not always going to agree with them and say, yes, we'll accommodate that. But it's a lot easier for me to work through a deal with someone if we know what that seller wants. Because you and I both know it's not always just the highest dollar value that wins, right? People are looking for something different. We lost, one of our most recent deals, we lost the deal, and I feel okay about it because what the seller was asking for is she wanted a 5-year employment contract. And I just said I wasn't comfortable with that. I don't know her. Like, she had built the business, but she was already in her mid-70s and she wanted to continue working for 5 more years. And I'm like, I don't know that fits with our plan for the business right now. So that wasn't part of my offer to say that we're going to accommodate that. I offered something different, and she wasn't terribly satisfied with that. And that's okay. But neither one of us would have been happy if we would have walked into a situation and I put her under a 5-year employment contract and she wasn't happy working with us.
Did she sell? I guarantee she did. She did not. Who wants the seller who has all the relationships throughout the company to be you'd be obligated to keep her for 5 years? No way.
I give her credit because at least she knew what she wanted up front. And I could say that doesn't fit with what we're dealing with here. But we've gone through a number of other transactions where we don't find out until late in the process. And then it ends up being a gotcha. So we've had that before where we get to, a week before and it's like, oh yeah, I forgot to tell you, I have a kid that works in the business and it'd be really nice if you could keep them employed. And it's like, oh, you didn't tell us that. I wish you would have told me that sooner. Or we've had like, I want to take a little bit of time off and then I want to be involved again and I want to take a fraction of responsibilities. So I think, again, everyone wants something different, but I think you've seen it, Ed, before where people finally choose to sell their business. They pick up their phone, they call the broker and say, let's get it done. And then over that next, call it 6 to 9 months that it often takes for a business to transact, they're getting cold feet and saying, maybe I should own the business longer. Maybe I'm not really ready to be done. Or you have the other end of that where they're just like, yeah, I want to be done on Monday. Can you be here Monday to pick up the keys, And it's usually somewhere in between that for us. But I really appreciate an owner who is really, truly ready to hand over the keys and say, I'm ready to move on, and this is what the next chapter looks like for me, and we can partner to accommodate that.
Before you go, Colin, the things that we see is we try to explain that there's an exit window, right? So it's going to take 6 months to a year for you to kind of get your arms around that this is getting ready to really happen. And that includes you got to get your books and records in order. You got to have your evaluation put together. You got to be going to something, right? Then you got your exit window of the execution of the deal where it's going to take 6 months to a year. It just is. And then there's a trailer that you're going to have to transition it. And selfishly, we get that used against us. We spend the time on the front end trying to prep the business, trying to educate, and I'll have a competitor just show up and say, oh gosh, we can get those idiots that we can get 30% more than that. And then it's funny because it just literally happened in the last month or so. Somebody came back and said, I am really sorry for not engaging with you guys because everything you said that was going to happen happened. And again, that's just by virtue of experience that we have that. But at the same time, it's funny in counseling people to prep their business for sale until you're in it. You have no idea that there's no way for a seller to vet what somebody like me says until you get to the marketplace and get punched in the face by a couple buyers.
I think you can say all the things you want to say about valuation and expectations on that front. The only thing I'll say about valuation that I think is a huge turnoff is when you see like 2 or 3 years of hockey stick financial performance and then layer on like a significantly higher multiple to that most recent year. Right. And it's just like the expectation curve is shot through the moon, even though maybe the last 3 years look a little different on average. So I think that's one thing where like you got the most recent year that's way higher and then trying to cash in on that can be a turnoff to me. Honestly, both sides of the table like could stand to have a little more empathy. Like buyers need to recognize that the seller like built something that they're really proud of and they're fighting, scratching, clawing their way to make that thing successful over a long period of time. And then sellers, I think could better understand that, hey, as a buyer, I know way less than you do as the seller of the business. And I'm taking on a ton of financial risk to do this thing. And so I think there's better opportunity for empathy on both sides of the table, in my opinion.
We're coming up on time. So I wanted to talk a little bit. You guys are looking at holding. What does this thing look like for you guys in the future? What long term?
Yeah, I think long term, what we want to do is build a mini Berkshire Hathaway. We want to have diversified holdings across a number of private businesses, and we'd really like to get into public businesses too. Colin has a lot of experience in the public markets, and we see there's actually a lot of crossover between public and private. I think at the end of the day, we want to be able to take our money and put it where we can get the best return. And sometimes that's going to be in owning a private business. Sometimes there's going to be opportunities in the public market. So we intend to grow and scale from where we are today. Colin, you want to add on to that?
I think you'll see us continue adding things to the portfolio and just slowly collecting what we think are good companies that we are willing to hold forever, even though, like I said, I don't believe in never sell. So you'll see us keep collecting things in the portfolio. We may not own 100% of everything in the future, right? We may partner with people that want to own a company and operate a company, and if we can bring some things to the table beyond just money to that situation. And then I think there will be some public company involvement where, we can take some of the things that we've learned and done in the private markets and go help some smaller public companies accomplish as well. And so I think the form will look a little bit different, but it'll be the same kind of slow rolling snowball of businesses. Yeah.
At the end of every episode that I've had, I've always asked the guest, what is the one thing that you could tell a business owner that would have an immediate impact on either the value or the saleability of their business?
I think the best thing to make a business really sellable is to make sure you keep clean financials and keep your business financials separate from your personal financials. The number of businesses that we look at that they say, well, it's really profitable. You just have to do these things, right? And you have to take out this car that's in here and these cell phone bills and these utilities are for my lake house and, all those things. I think it makes it really, really a turnoff for buyers when you find someone who's trying to, I'd say, milk it on both ends, right? During the life of their business, they're trying to take some tax advantage, take some personal gains by having a lot of personal expenses in their business, and then they're expecting a buyer to come in and just really forget that all those things happen and pay a huge multiple on what their earnings are. To me, that just, one, it's complicated and confusing for a lot of people. Two, it just really sets a different level, a different tone for the transaction. I want to be able to trust the person that I'm buying from, and someone who's willing to do those things in their personal business, their personal life. I just say, what else are they hiding in the business? What else are they not telling me about this transaction?
It depends. I think there's something, it's like being reasonable, right? And it's hard to, as the buyer with limited information, way less information than the seller, to come in and be like, yeah, let's just play the trust game and this will all work out. So it's funny, you took the financial side of things. I actually think having that Michael Gerber E-Myth mindset of how do I make this turnkey is super important going into that, because we've come in on day one and just the brain dump as you're trying to hand over those things and shadow that seller and then slowly peel back all the things they do. That's really challenging, and that takes more time than just write out everything you do in a week's time, right? Capturing the things that only happen but once a year, once a quarter, maybe once every couple of years. Those little things slip through the cracks. And so the more you can remove yourself as owner from bits and pieces of the company and make that turnkey to hand over to someone else, I think that makes a business insanely more valuable.
Interesting. How do people get in touch with you?
Yeah, so people can always find us online. Our website is circlecitycapitalgroup.com. We have a web form there, or you can find both Colin and I on LinkedIn. So pretty easy to connect with us in one way or another. As I said, we're both here in Indiana, and we're active in the community and always happy to meet other like-minded entrepreneurs and business owners.
All right. This has been long overdue. You've been on my short list to come on the podcast. So thanks, guys.
Love it. Thanks, Ed.
Thanks for having us. We appreciate it.
Thanks for listening to the Defenders of Business Value. If today's episode helped you think differently about building or selling a business, follow the show so you don't miss what's next. And if you want to become a more informed, confident owner, the one who knows how to grow, protect, and eventually exit at maximum value, subscribe to my newsletter. The link is in the show notes. And if you're ready to talk about your next deal, connect with me on LinkedIn. So until next time, we'll see you soon.